All right, let's talk about the markets. We're breaking down what happened on Thursday, October 16th, 2025. And what a day it was. I mean, it was a classic case of a split personality, really exposing this deep conflict happening right under the surface of the market. So, yeah, let's get into it. Really, the whole story of the day boils down to one thing: a massive intraday reversal. Seriously. The morning kicked off with this huge wave of optimism, fueled by some just incredible news coming out of the tech sector. But by the time that closing bell rang, that optimism was gone, just poof, vanished, replaced by this sudden, sharp wave of fear that just dragged everything down with it.
And you can see that reversal right here. We opened strong, all fired up about AI. The tech-heavy NASDAQ was up a full % by midday. But then, boom. Late in the session, this sudden fear about the banking sector just slammed the brakes and triggered a huge sell-off, pulling every single major index into the red. It was a textbook tug-of-war. And well, the bears won the final pull.
Okay, so here's how we're going to break this all down today. First, we'll look at the two competing stories that really defined the day. Then, we'll dive into the major forces that were colliding. After that, we'll explore three possible paths forward from here. And finally, we'll wrap up with the final word on what this all means.
All right, let's start with part one, looking at how this really turbulent day wrapped up, and really focusing on those two very different narratives that were fighting for control from open to close.
And here are the final numbers, the scoreboard at the end of the day. And yeah, despite that strong start in the morning, all three major indices closed deep in the red. The S&P 500 was down over 0.5%, and the NASDAQ and Dow weren't far behind. A clear win for the bears by the closing bell.
So, if you wanted to boil the entire day down to its core conflict, this is it, right here. On one side, the biggest positive. Just undeniable proof that the AI megatrend is the real deal. It's strong, it's profitable, but crashing right into that was the biggest negative. The sudden and frankly terrifying return of credit crisis fears, all kicked off by a single regional bank. Hope versus fear, all in one day.
So now let's dig a little deeper into these two massive opposing forces, the AI boom versus the fear of a credit crisis. This was a head-on collision all day long.
What's so fascinating here is how clearly you can see the evidence for both sides. I mean, for the bulls, you had TSMC posting a jaw-dropping 39% profit jump. Plus, you had the Fed signaling that they're ready to loosen things up. We're talking potential rate cuts and an end to quantitative tightening, where the central bank shrinks its assets. Huge tailwinds. But the bears had a bombshell of their own. Zions Bancorp pre-announced a big loan loss, and that just sent the Russell 2000, that's the index of smaller companies, plummeting over 2% as investors just ran for the exits.
And this quote right here, it basically became the rallying cry for the bears. It's an old warning from JP Morgan CEO Jamie Dimon, but it just resurfaced and spread like wildfire. The fear wasn't just about one bank losing $50 million. No, the real fear was that this was just the first cockroach, a sign of a much bigger hidden problem festering in the credit system.
And you could see this exact conflict play out in individual stocks. Zions Bancorp, the company that started all the panic, it just cratered, down over 13%. But at the exact same time, you had stocks like Micron and Salesforce surging on AI optimism. And look at JB Hunt, completely different story, soaring almost 20% on a killer earnings report. But then you have the real puzzle of the day, TSMC. They had blowout, fantastic results, and the stock still dropped. That's a huge tell. It shows that the broad market fear was so strong, it could completely overpower amazing company-specific news.
And just to show you how wildly bullish the other side was, this was the kind of talk coming from big investment banks like UBS. They weren't just optimistic. They were calling for a once-in-a-decade supercycle for memory chips, all thanks to the insane demand from AI. I mean, these are two totally different universes colliding in the same market on the same day.
Okay, so as that cockroach fear really started to take hold in the afternoon, where did all the money go? Well, it didn't just disappear. It fled. It ran from stocks and poured into the classic safe haven assets.
The first big red flag was this. The VIX, which you probably know as the market's fear gauge, it spiked a massive 22% and hit a 4-month high. Now, this isn't just a little bit of nervousness. This is a sudden, sharp jolt of anxiety ripping through the entire market.
That fear sent investors scrambling for the safety of U.S. government bonds. The buying was so intense that it pushed the yield on the 10-year Treasury note below that really important 4% level for the first time in 6 months. And remember, when bond prices shoot up, their yields fall. This is a classic flight to quality.
And of course, the ultimate safe haven, gold. The precious metal surged over 2%, blasting past $4,300 an ounce. This was actually gold's 9th straight week of gains. That rally is being fueled by both the credit fears we're talking about and, concerns that future Fed rate cuts could devalue currencies.
So the market is obviously at a major crossroads. The big question is, what does it all mean for investors? Let's walk through 3 potential scenarios for what could happen next. Okay, scenario 1 is pretty simple. You bet on AI's structural strength. The thinking here is that the whole AI revolution is a huge multi-year megatrend, right? And these banking fears are more of a short-term cyclical headache. Plus, with the Fed likely to cut rates, the play is to stick with the big dogs, the established leaders like Nvidia. The big risk, of course, is that these stocks are already priced for perfection, and there's still a lot of uncertainty about long-term demand. Scenario 2 is the exact opposite. This is the defensive play. This strategy is built on the idea that the cockroach theory is right and that the credit problems we're seeing are just the beginning. In this world, preserving your capital is way more important than chasing gains, so the move is into safe havens, like a gold ETF. The obvious risk? You could miss out on a massive AI-fueled rally if these crisis fears turn out to be nothing.
And then there's the third path, which is more of a balanced approach. Focus on the value chain. So this logic says, yes, the AI boom is 100% real, but let's not chase the most expensive, hyped-up names. Instead, you target solid, established companies like Salesforce, companies that have real concrete plans to actually make money from AI and improve their bottom line. It's a way to play the trend without taking on that insane valuation risk.
All right, so let's wrap all this up with the final word on where the market stands right now and the most important risks you need to be watching.
So the bottom line is this. The market is stuck. It's in a state of extreme tension. You've got this powerful long-term force for good, the AI boom, colliding head-on with a dangerous short-term fear, a potential credit crisis. And this direct conflict is what's fueling the wild, whiplash volatility we're all seeing. Every piece of news, good or bad, is just pulling the market in opposite directions.
So looking ahead, it really all boils down to 2 huge questions that we need to watch. First, credit contagion. Is this thing with Zions just a one-off, an isolated incident? Or is it really the first cockroach signaling bigger problems, especially in the less regulated private credit markets? And second, AI's end demand. We know tech companies are spending billions building the infrastructure, the supply. But will businesses actually adopt the technology fast enough to generate the profits, the demand, to justify that massive investment? The answers to those 2 questions will probably tell us where the market goes from here.
And that leaves us with the ultimate question, doesn't it? In this high-stakes game of chicken between the structural hope of a tech revolution and the cyclical fear of a financial crisis, which side is going to blink first?